In case you missed it, this week our ETF strategist Bipan and Erin hosted a Reddit AMA where he dove into your questions on all things ETFs and portfolio construction. There were some great questions, and we thought we'd bring them here to ETF Market Insights and unpack some of them in case you're not a Redditor. So stay tuned as we unpack these questions. I also wanted to remind everybody that if you do have questions, you can email us directly at etfmarketinsights@bmo.com and we will get back to you. Or you can just drop them in the comments below. Before we get started, a quick reminder, we are not providing any investment advice or recommendations. Today is all about your questions and our answers. Bipan, welcome back to the channel. You survived your AMA.
I survived. It's good to be back.
Let's dive into what we felt were some of the more popular questions from the AMA. So the first one that I wanted to highlight was a question from a Redditor who was thinking of purchasing ZEQT, our BMO All Equity ETF, which is an asset allocation ETF that invests in a number of underlying index-based ETFs. And they were asking for more information on how the actual underlying mix of ETFs is set, and then again, how they are rebalanced. So maybe you can walk us through that, Bipan.
So, great question to start off today's recording. And first thing I'll say is that you can find information on our suite of asset allocation ETFs on the BMO GAM website. Again, there's a comprehensive list of ETF there and a lot of detail provided on the website. So, anytime anyone's got a question with respect to any of our ETFs, that's usually my first answer or response to their question. Now, for ZEQT in particular, since that's what the question focused on, it's important to mention or highlight the fact that rebalancing tends to occur on a quarterly basis. And rebalancing tends to be more or less aligned with the strategic asset allocation weights. Now, by geographic region, that tends to correspond to 50% US, 25% Canada, and 25% for the rest of the world. And again, if you're wondering about why the ex-Canada weights are the way they are, those are determined and follow MSCI World Index weights on their own. So, and an important item that I should also flag is that we're only a few months removed from our fee cuts to our suite of asset allocation ETFs. Now, we've got the lowest or the cheapest asset allocation ETFs in the Canadian market, something that we're very proud of right now. At the same time, performance has been really, really good. So, and something that is important to flag there. One other thing that I'll mention, insofar as any specific questions are concerned, it's best to consult your financial advisor who can advise based on your particular financial objectives and also your risk profile as well.
Thanks for going through that, Vipin. The next question we had was, how do you see the growth of ETFs impacting the valuation gap between large cap and small cap names?
Yeah, it's a great question, and certainly something that's been a hot topic of debate for some time now, especially amongst analysts that are concerned about the current degree of valuation for U.S. equities. But remember that when we're talking about market cap weighted ETFs, those are structured based on rules and not so much on valuation. That means that ETF flows can often lead to more dollars being allocated to a few mega cap names that are highly liquid. That, of course, can curb volatility over time. But we can also extend that criticism towards the process of indexing more directly as well. And so while ETFs don't necessarily create the valuation gap, there's certainly a strong argument to be made that they can help to sustain it over an extended period of time. Now, the large cap versus small cap decision is largely a macro or regime call in our view. And in some regimes, small cap ETFs can actually outperform, and especially when rates have bottomed, the growth outlook is starting to improve, and large caps look overvalued. And again, if some of that sounds familiar, this should be one of those regimes potentially where small caps can do relatively well. But one of the other points that we want to make is the fact that these are often episodic in nature. And again, episodic meaning that they can be tactical in nature more often than not. And as I mentioned earlier, there's a good case to be made that we're likely in one of those tactical or episodic regimes right now.
Awesome. Yeah, I think that was a really interesting question. And then the next question we had was around factor ETFs. So BMO ETFs has a wide range of factor ETFs, everything from low vol, dividend, value, quality. The question, which I swear was not planted, is BMO planning on launching any new factor ETFs this year?
Yeah, great question. And, while I can't speak to specific product launches just yet, what I can say is that we're always looking to explore ways to expand our lineup with thoughtful, innovative solutions that meet the evolving investor needs. Now, factor investing continues to be an important area of interest for us. And in fact, we just launched the BMO MSCI Canada IMI High Dividend Yield Index ETF, or ZDIV. And we also, of course, just launched our BMO MSCI USA Equal Weight Index ETF, or ZEQL. But again, we'd encourage everyone to stay tuned, stay up to date with what's going on our website for all the latest information on potential new launches and how we could be expanding our suite of factor ETFs going forward.
Awesome. Yeah, I think ZDiv is a really great launch. We just launched that last week, I guess it was. So that is new to 2026. Lowest cost in its category, right? At 9 basis points. Broad Canadian total market approach to a high dividend mandate. Very attractive fees, and similar on ZEQL. That we launched that at 5 basis points, which sort of blew my mind. It's the lowest cost equal weight mandate in North America for the U.S. market as well. So
Our timing was impeccable on that, Aaron. I got to say, just because it does feel like the macro is gravitating towards that direction. So very, very good on us for getting that to market.
yeah, the equal weight is nice for anybody, and we're going to be talking about that on a future episode. But anybody who feels that the U.S. market is getting a little over concentrated in those tech names, so more on that to come. Um, all right, Bipin, the next question that we had was, what's the biggest risk you see for the markets over the next 12 months? And what's the biggest opportunity? And then how would you play that with ETFs?
I mean, given what we've seen so far in 2026, so this is a question we have to be clear-eyed about because there's a lot of things that can happen in the geopolitical space that can really throw our plans into a bit of a loop. But traditionally, I mean, as an extension of what I just said, the market has been terrible at predicting that, a general rise in geopolitical risk premiums, and for good reason. But on the whole, we think that the bearish tone to commodities is a direct result of what's been happening in that space. And for instance, the sustained momentum in a market like copper could be traced to China front loading its demand given the more fractured trade backdrop. And in a similar way, the situation of Venezuela and Iran, will have profound implications for the energy space. But outside of that, I mean, there are other risks that we're monitoring relatively closely. For one, there are risks to the labor backdrop in the United States that could deteriorate a little bit faster than we're expecting, and that could necessitate even more stimulus from the Federal Reserve relative to what we're expecting. And that could also mean that earnings growth potentially does stabilize with more modest expectations going forward. And again, that will have implications potentially for sectors like tech and telecoms, which have done extremely well in the earnings space of late. Additional risk, and I think this is more macro in nature, not so much concentrated to the United States, is the fact that inflation could actually end up being a little bit more stickier than most of us are expecting. And again, that will lead to a reassessment of how we're viewing the macro space if that does happen. In Canada, it's no secret. I think the biggest risk is still very much the economic backdrop, or at least what the trade relationship with the U.S. will mean for the economic backdrop. And that, of course, is going to depend heavily on upcoming review talks for the USMCA agreement, which are scheduled to begin in the latter part of the spring and early part of the summer. So, in an uncertain backdrop like this, where we could point to several different things that could go wrong, there's a strong case to be made for commodities, including one of our more recent launches, the ZCOM, which tends to track the Bloomberg Commodity Index. And that's one that we feel that could be well supported in, a fairly good ETF to look at in this sort of uncertain backdrop that we're headed into. Certainly any sort of exposure to emerging market exporters of commodities, that could also bode well going forward as well. So, a product like a ZEM, which is, of course, our BMO Emerging Markets Index ETF, that is a product also that we've been looking at quite closely for the coming quarters.
Great. And just for the listeners, if you do want to get access to Bipin's commentaries, we do send these out in our weekly newsletter. So check that out. If you go to etfmarketinsights.com, you can get on our mailing list for that to hear more. Wrapping it up with our last question that we wanted to get through today, Bipin, how do you recommend balancing Canadian versus global exposures in ETF portfolios with the current currency and rate environments?
another fantastic question. I mean, Canada might not be the global growth engine from a macro perspective, but Canadians should ensure that there's still a healthy degree of exposure to the domestic market within their portfolios. Now, between the fixed income and equity sleeves of our balanced portfolio, we always like to ensure that at least 25 to 45% of the exposure is to Canada. That allows us to ensure that we have a more meaningful footprint in the home market while avoiding some of the regional concentration risks can develop. And certainly there's been a big one with overinvestment in the United States over the past several years. The other item to remember is that by investing outside of Canada, we are making an implicit decision on the direction of the currency, whether or not we're hedging. And FX risk, there's been studies done that corroborate this, but FX risk is not rewarded over the long term relative to the inherent risk that you're taking on by making that call. So again, the key reason for that is the factors that drive currency pairs, including dollar Canada. The relationship they have with the pair itself is not stable, and those can change frequently over time, and they can be very, very difficult to predict. But under the current regime, we like holding Canadian equities, and true, there's a lot of exposure there to domestic financials and materials as sectors, but we still think there's upside for both, given the fact that Canadian banks are flush with capital and that miners, including gold miners, should continue to benefit from higher commodity prices. And yes, again, there are risks to the economic backdrop from trade and what our relationship with the United States is going to look like. But Bank of Canada policy settings aren't really that restrictive relative to where they were, say, a couple of years ago. And, given what we know now, layer that in with what's happening in terms of the broader commodities market. I mean, it still feels like a supportive backdrop for the Canadian market.
Bipan, great insights. Thank you for taking the time with me today. And thanks to our listeners for tuning in. That's all for today. We'll see you next time. Bye for now.